let's talk with Jeff Small. Good to see you, Jeff.
Hey, Dave. It's great to be here again today, and even with all of our esteemed guests. I'm looking forward to today's topics.
Yeah, and I bet you're particularly excited for us to introduce our first guest, John Najarian. John is an options trader and co-founder of MarketRebellion.com. John's also the co-author of the book, Follow the Smart Money. John, it's great to have you back here on The Income Generation.
Dave, thank you. Jeff, great to be with you both.
Hey, great to see you again, John. Want to keep the dialogue open here on what's happening with the markets right now and for the rest of 2021. It seems like we are in the massive MMT mode, more money today. That's part of what's fueling this rally. When do we see the money supply start to contract or the Fed start to taper, which will ultimately affect the markets?
That's, of course, the trillion-dollar question, or several trillion-dollar question, Jeff. And instead of modern monetary theory, I like your definition of MMT more. But I think the Fed is going to have to start addressing this before the end of the year with a tapering, but not with tightening. I don't think that tightening happens for quite a while. And depending on what happens with the tax bill, Jeff, that'll have a little, believe it or not, that helps the Fed. Because if, and I'm hoping that they don't increase taxes as dramatically as they've said. I know Joe Manchin's against it, the senator from West Virginia. He's about, moving corporate taxes up a little to like 25, not to 28 or 30 like the administration wanted, and or that millionaires tax on capital gains. I think any of those things do moderate growth, even though we're going to get a spike in the short term for demand because of all the money that's been given out. So my answer to you, Jeff, is that we're going to probably see that tapering in the fourth quarter of this year, but no tightening because I think that'll be taken care of by what happens with or without the tax increases.
We find ourselves in a position now where history always seems to repeat itself, but the biggest lesson of history is people don't seem to learn from it. We've seen this script in this movie before as we have record levels of debt. When does this become an issue? Does it ever become an issue? Does the debt just keep expanding and it's something we have to learn to accept?
Well, unfortunately, yes, is the answer. We're going to have to accept it. I don't see us just dismissing it. I think when the interest rates do start moving up, which we covered already, when that starts happening, then it becomes more incumbent on the government to either rein in some of the spending or increase taxes, which they love to do anyway. They love to do both of those two things because you get reelected giving away money, and you are appealing to one side of the Democratic Party when you increase taxes. Obviously, I don't think you'll get a single Republican vote on that increasing taxes part. But sooner or later, yeah, the bill does come due and you got to pay the piper. And that's something that we all worry about. The debt has increased so dramatically since 2008, and it's just on a collision course with bad news if we have significantly higher rates. If the rates moderate, and if we get up to 2 for the 10-year and maybe even 2.5 next year, that's okay. But if we blow through 2 this year and are on our way to 3 or 4, which is where we were before the crisis, that's a really bad thing because that debt load is enormous and it gets heavier with higher interest rates.
Oh, that is such a good point, John. I mean, if rates go up with the debt load that it's at, it's going to be really hard to service. We're going to have problems. However, do you see rates being increased by the Fed or just going up organically because of the consumer demand and the economic expansion? Tell us how you feel about that.
I think it goes up at first because of the latter, that consumer demand, not because of the Fed, because of actual supply and demand, just as the three of us always talk about. Those are things that move the market. If you have more demand and less supply, you're going to move rates up. And I think that will happen. But then I think the rest of the world will respond to it as they've started to anyway, I guess, Jeff, because you've seen a lot of euro dollar investments, a lot of yen, of course, investments convert over into our bonds. Why? Because they're paying a yield that is significantly higher than what they can get over in those countries. And if they've got negative rates over there and they're able to come over here to ours and get nearly 150 to $2 to 2%, which is where the 10% that 10-year is moving towards that 2% target. That's where I think you get the money flow that kind of holds the bonds back from otherwise going significantly higher, because the more bonds they buy, the rate moves down. So I think that's a moderating mechanism.
So John, thanks so much for being back with us today on the income generation.
Thank you.
So Dave, it's been a very interesting 18 months as we've gone through COVID to watch what's happened with rates and what the exact effect on credit spread compression has been. And so what we have found is people that have held on to their bonds, of course, the prices have gone up, which drives the yields on bonds lower today, causing that compression. But people that have held their bonds, values have gone up and they've been able to weather this small increase in rates since the beginning of the year. How do you see it?
Yeah, and not only that, but also, there's other bond-like instruments that can create, that can do well in the rising interest rate environment. So if somebody has maybe a little bit in something called BDCs, maybe a little bit in something called real estate investment trusts, that can always help too.
No, there's no doubt about that. Investing for income in the stock market can also minimize risk in a rising rate environment, but we're really not threatened by a substantial increase in rates by the Fed. This rise happened because we hit a low point. Rates dropped to 0.5% on the 10-year because there was no confidence in the economy. And then once the Fed had the open checkbook mentality, what happened? Rates started to go up as the economy gained more traction.
Sure. Yeah, and the rates went up, the economy gained more traction. But again, it's not because it's Federal Reserve manipulated, it's because it's authentic. We're seeing better GDP numbers, we're seeing some inflationary pressures, and because of the good news, economic news coming out, it's an organic increase in interest rates, and that's why it's still been good for pretty much every market so far. Now Jeff, it's time now to bring in another one of your favorite guests, and that's Michael Stewart. Mike is the founder of Crystal Lake Tax and Financial. He's also co-author of the book, Purpose-Based Investing. Michael, thanks for being back with us here on the Income Generation.
Appreciate you guys having me.
So Mike, it's great to see you.
Jeff.
Thank you. Well, listen, I'm curious. If we look at the last 30 days of activity in the markets, tell us about some of the feedback you're getting that's instinctual from your clients and customers and how they view the market at this particular time. What are they telling you about how they feel about the markets?
Yeah, realistically, they are kind of on edge. If you go back a year ago, we had kind of in 3 weeks that 30% drop back in March 2020 as all this coronavirus thing was rolling out. And then we've had a great recovery since. But they also realize that a lot of this recovery, which is based on the government kind of propping everything up, kind of borrowing trillions and trillions of dollars. So on one side, they're a little bit optimistic and they kind of want to hang on, just thinking that, as the economy reopens second half, then maybe things will improve. But they also are a little bit more realistic and they worry that it might be priced in a little bit as well.
Sure. And so, what I've seen, Michael, is that there's a flair for people being concerned about the political realm and the effects on what can happen with the economy too. So there's a trifecta of sorts in terms of what people are concerned about. But how can the income model help our clients overcome their uncertainty at this time?
Yeah, I think this past 12 to 15 months has been a great example of why the income model makes sense for a lot of individuals that are either close to retirement or in retirement. If you take 2020 as an example, you kind of had, the best of worlds and the worst of worlds. And one of the reasons the income model made sense for a lot of those nearing and in retirement is that although that there was volatility, whether it's in the stock market, if you're in dividend paying stocks, or even just various fixed income bonds, bond-like instruments, what didn't change throughout the year with all the uncertainty and, waiting for shoes to drop and things was the fact that the interest and dividends continue to be paid. So for those that either wanted organic growth or just wanted to have a little bit more consistency of income in their portfolio to either reinvest or take, they were able to continue to get that throughout the year, independent of what market conditions provided.
And even more so than that, Michael, appreciation has been crazy, even in income accounts, with the rise of the markets the last 12 months. Are you seeing that yourself?
Yeah, we're seeing that as well. In our income models, we tell clients, take away the equity portion of it. typically 4 to 5%, consistent returns is kind of where our sweet spot is. But we've seen a lot of the principal on a lot of these kind of bond-like instruments, these bond proxies, continuing to go where they're actually getting double-digit returns on their fixed income as far as total return goes.
Michael Stewart, thanks so much for being back with us today and being such a good friend of the income generation.
Thanks for having me.
So Dave, I have found over the years, and more so than ever, investors really don't understand the difference between growth stocks and dividend stocks. As a matter of fact, Dave, what compounds that problem is the fact that every financial advisor is out there promoting growth, and they don't even understand the difference between growth stocks and dividend stocks and how to create income. Tell me about some stories that you want to share with the audience in that regard.
Well, it's interesting because I think the biggest thing, without overcomplicating it, is that 90% of investors, when they talk about growth, they mean capital appreciation. They mean buying a stock at one price and having it go up to a higher price. Whereas when you and I, Jeff, talk about growth, we're talking about growth or momentum investing versus value investing. So I think for many, the problem really resides in the basic understanding of that definition.
There's no doubt that it does, but it doesn't change the fact that investors all have tunnel vision, Dave. They either are in the market and they are accepting the potential for risk, even at these all-time stock market peaks, or they're completely in cash today because they're petrified of what's going to happen. There's what could happen. There is no middle ground from their perspective because the culture financially has never shown them any other opportunities. That's what we do every week on the Income Generation, is teach people about income and how to maximize that opportunity as an investing platform.
You're right. I mean, so many advisors today got in the business in the 80s and 90s, the best stock market in U.S. history. And as a result, they became growth-based advisors. And maybe those that came in after that, after the year 2000, are those that are a little gun shy that you talked about, that might be sitting in cash. And the same is true for investors, depending upon when you got started, whether you got started in the 80s and 90s or you got started after the year 2000. And I think that's a great segue to introduce our final guest, and that's our good friend, Matthew Johnson, president of Johnson Wealth and Income Management in the great state of Iowa. Matthew, it's great to have you back here with us on the Income Generation.
Thanks for having me, guys. It's always a pleasure.
So Matthew, we always have fun every time we get together, but I got to tell you, in the NBA, they fear the beard, as in James Harden. But today, should people be fearing the markets? Tell us what your clients are feeling.
I think that there's a great deal of skepticism right now. It's like very surreal. The market continues to go up, and they want to be a part of that growth, right? It looks really attractive. There seems to be a lot of optimism. And yet at the same time, there's always kind of that nagging fear in the back of their minds that it's not real and it's not going to continue to go up. It's going to have that revert where it goes back the other direction. And so there's a lot of fear. I think a lot of skepticism. People are ready to pull the trigger and get out at any time.
So they are fearing the market then at this point, because a lot of them are saying, you know what, the market's at an all-time high. We're printing up all of this money, massive money printing, more money today, MMT. It's crazy what's happening. And I think it's scaring consumers. And so I'm not surprised to hear you say that. So give us your forecast on what you think the market's going to be like the next 6 to 12 months, or when should customers really consider de-risking is the real question, MJ.
Well, at least in the time being, I think things are going to continue to stay fairly moderate as far as, I think maybe we may be over the hump as far as the exponential growth right now. It'll continue to grow maybe a little bit. I don't see this current administration making too many waves, but I think towards the end of the year, that's when we really have to really start reassessing the risks that we're taking on our money. We've got all sorts of proposals that are on the table, things that in some way, shape, or form can very much affect the stock market. Whether it's a bunch of real estate being sold because people want to realize the capital gain in 2021 versus 22. There's going to be a lot of factors that could create volatility towards the end of the year and going into 2022. So I think keeping your ear to the rail and really paying attention to how much risk you're taking on is going to be super important.
Matthew, it's been great having you on board as usual. Thanks so much.
Thanks so much.